Let's unpack something absolutely critical for our shared future. Energy.
Right.
Not just energy, but sustainable energy. Specifically, we're diving deep today into the world of green hydrogen.
A really fascinating area.
And there's a unique opportunity emerging in this space, the HydroGenesis Investment Fund. We're thrilled to have someone here who can walk us through this landscape kind of from the inside.
Thank you. It's a pleasure to be here. Think of this as a window, really, into how our team at HydroGenesis sees the immense potential of green hydrogen.
Yeah.
Not just as a concept, but as a tangible investment frontier. We'll explore what makes green hydrogen so revolutionary and how we're approaching the opportunity it presents across the entire value chain.
Excellent. So our mission today is to understand the what and the why behind green hydrogen. We'll look at the global momentum driving its adoption and then really get into the specifics of how the HydroGenesis Fund is structured, how it's investing in this, rapidly evolving market.
Sounds good.
We'll be navigating this like an interview. I'll be asking the kinds of questions you, our listener, might have about stepping into this potentially transformative area. So let's get started. I'm genuinely excited to explore this with you.
The excitement is mutual. It's a sector we live and breathe, and the opportunity is just immense.
Right. To really grasp the significance of green hydrogen and the investment case, we have to start with the big picture.
Absolutely.
And the biggest picture today, arguably, is climate change. How does HydroGenesis view the current state of the global climate challenge?
We see climate change as, the defining challenge of our era. It's not merely an environmental issue, it's fundamentally reshaping economies, policies, technologies worldwide.
It touches everything.
It really does. And the science is, frankly, unequivocal. Human activities, primarily burning fossil fuels, are releasing greenhouse gases at an alarming rate.
What are the primary drivers of those emissions that you focus on when you're thinking about solutions?
Well, the key culprits are the obvious ones, really. The sheer volume of carbon dioxide released from combusting coal, oil, natural gas, for power, transport, industry.
The big emitters.
Exactly. But we also have to factor in things like deforestation, which removes those natural carbon sinks.
Right.
And specific industrial processes that emit other potent gases, like methane or nitrous oxide. Understanding the sources of these emissions, that's crucial for identifying where solutions, like hydrogen, can have the biggest impact.
And the impacts of this, they seem to be escalating almost month by month. What are you seeing in terms of consequences?
We see a cascade, really, a cascade of consequences. Rising global temperatures mean more frequent, more intense extreme weather.
We see it in the news constantly.
Devastating heat waves, unprecedented floods, prolonged droughts. These aren't theoretical future problems anymore. They're impacting supply chains, infrastructure, communities right now.
It's tangible.
Very. And then there are the profound disruptions to natural ecosystems, accelerating biodiversity loss. Direct threats to essential resources like fresh water, food security, rising sea levels, too, posing existential risks to coastal populations and critical infrastructure.
It's a huge interconnected problem.
It is. And all of this just underscores the urgent need for a cohesive global response, one that transcends national borders.
That urgent need for a global response, I suppose, brought us to the Paris Agreement back in 2015. From your perspective at HydroGenesis, how significant was that agreement?
The Paris Agreement was absolutely pivotal. Yeah, pivotal. It marked a collective global acknowledgement of the scale of the challenge and, importantly, a commitment to coordinated action.
So a real turning point.
Definitely. Adopted at COP21 in December 2015, it set a clear framework for countries to unite their efforts.
And the core objective laid out in Paris, what was the headline goal?
The central goal was to limit global warming to well below 2 degrees Celsius above pre-industrial level.
All right, the 2-degree target.
With a critical aspiration, really, to keep it to 1.5 degrees Celsius. And that 1.5 degree target, that's become the increasingly urgent benchmark, hasn't it? Reflecting the latest science on the severe risks, even at slightly higher temperatures.
How did the agreement structure the commitments? Because it wasn't a top-down mandate, was it?
No, and that was its innovation, really. It's built around nationally determined contributions, or NDCs.
NDCs.
These are voluntary, country-specific climate action plans. They outline emission reductions, adaptation strategies.
So each country sets its own path.
Yes. But the genius is the mechanism for increasing ambition. NDCs are reviewed and updated every 5 years with the expectation that each successive plan will be more ambitious than the last. It's designed for continuous improvement, ratcheting up the effort over time.
So it's designed to accelerate. What about tracking progress globally? How does that work?
That's handled through the global stocktake. This is a regular assessment process, looking at the collective progress towards those long-term goals.
Like a global report card.
Sort of, yes. It helps countries see where they stand globally, identify opportunities to enhance their efforts based on the latest science, new technologies. It's essentially a feedback loop to ensure the world stays on track, or at least understands where it's falling short.
And the financial aspect is crucial, isn't it? Especially for developing nations making this huge transition.
Absolutely. A key component is encouraging financial support from developed countries to aid developing nations. This funding is vital.
Why so vital?
Well, it enables them to transition to low-carbon economies, invest in clean technologies, build resilience to the impacts of climate change that are already happening. It acknowledges that climate change is a shared problem, you see. It requires shared resources, collaboration. The Paris Agreement really cemented this idea that collective inclusive action is, well, non-negotiable.
Okay, building on Paris, we've seen this wave of countries committing to carbon neutrality, often targeting 2050. What does achieving net zero or carbon neutrality by 2050 truly entail, from HydroGenesis's perspective?
Achieving carbon neutrality by 2050, it means balancing the total amount of greenhouse gas emissions released into the atmosphere with the amount removed.
So emissions in equals emissions out, essentially.
Exactly. The goal is net zero emissions. Now, this doesn't necessarily mean zero emissions in every single sector, but rather that any residual emissions, the ones that are really hard to eliminate, are offset by deliberate removals, like planting forests or using carbon capture technologies.
Okay, net zero, and the requirements to actually get there by 2050. It sounds like a monumental transformation.
Oh, it is. Perhaps the largest economic and technological transformation since the Industrial Revolution. The requirements are multifaceted, demanding. First and foremost, it requires a rapid, massive-scale transition to renewable energy.
Solar.
Wind, hydro, geothermal. This isn't just adding a few panels here and there. It's fundamentally shifting our entire energy base away from fossil fuels. That's foundational for decarbonizing the electricity sector and heavy industry.
So it's not just cleaning up the grid, but cleaning up everything the grid powers, plus those sectors that don't even use the grid directly.
Precisely. Which brings us to the second point. It necessitates the development and deployment of innovative technologies. This is where those hard-to-abate sectors come in again.
The tough nuts to crack.
Exactly. Areas like steel production, cement, long-haul transport, certain parts of power generation where direct electrification is either technically really challenging or just prohibitively expensive right now. Solutions like advanced energy storage, carbon capture, and crucially, green hydrogen production. These are essential.
Why essential?
They're essential for addressing these emissions and ensuring energy reliability as fossil fuels are phased out. You need something dispatchable and clean.
So filling the gaps where today's renewable tech isn't a perfect fit on its own.
Exactly. Third, it requires a fundamental shift in practices across society.
What?
Implementing energy efficiency measures everywhere, promoting public transport, embracing circular economy principles to cut waste and energy consumption.
Systemic change.
It's about systemic change in how we live and work, yes.
And none of this happens without governments really setting the stage, right?
No, policy frameworks are absolutely critical. Strong government policies, regulations, they're necessary to guide investment, provide incentives for sustainable practices, create the right market signals, and ensure accountability. Governments play a vital role in creating the necessary ecosystem for this transition to succeed.
While the challenge is clearly enormous, you also frame this transition as a major opportunity.
Absolutely. From our vantage point, the transition to a sustainable energy system driven by these net zero targets isn't just a cost or a burden. It presents unprecedented opportunities for economic growth, for innovation, job creation, and actually improving quality of life globally. It's creating entirely new industries and markets as we speak.
Okay, so that sets the stage very clearly. The critical need driven by climate change, the global commitment forged in Paris, those ambitious 2050 targets, and the need for transformative technologies, and crucially, investment. Let's zero in now on one of those core transformative technologies, green hydrogen. From hydrogenesis's perspective, what exactly is green hydrogen?
Okay. We define green hydrogen simply as a clean and versatile energy carrier. But the key is how it's produced in a way that aligns with our sustainability goals.
And how is it produced specifically to earn that green label? What's the defining factor?
The defining method for us, and for the industry standard really, is electrolysis powered by renewable energy sources.
Electrolysis, splitting water.
Exactly. This process uses electricity generated from wind, solar, or hydropower to split water molecules H0 into hydrogen and oxygen anO. The absolute key is that the electricity used is zero-carbon renewable power.
So renewable electricity plus water equals clean hydrogen. How does that differ fundamentally from how most hydrogen is produced today?
Well, the vast majority of hydrogen produced today, often called gray hydrogen, is made from natural gas through a process called steam methane reforming.
And that releases CO2.
Yes, significant amounts of co-euros into the atmosphere. There's also blue hydrogen, which attempts to capture some of that CO, but it still relies on fossil fuels as the feedstock, and the capture isn't always perfect. Green hydrogen, by using renewable energy for the electrolysis, ensures the production process itself is virtually emissions-free. That's the critical distinction for achieving true decarbonization.
Are there other promising green production methods you keep an eye on, perhaps further down the line?
Yes, definitely. While renewable electrolysis is the most prominent method scaling up today, we actively monitor other innovative techniques that could contribute to sustainable hydrogen production in the future.
Such as?
Things like pyrolysis of methane, sometimes called turquoise hydrogen, which produces solid carbon instead of CO2. Waste-to-hydrogen processes look interesting, and various thermochemical or biological approaches like biomass gasification. It's a dynamic area with a lot of ongoing R&D.
Fascinating. So it's not just one pathway, potentially. Why is green hydrogen considered such a crucial piece of this whole energy transition puzzle? What are the key benefits you see?
For us, the significance of green hydrogen is multifaceted. First, its ability to decarbonize those critical, hard-to-abate sectors we mentioned earlier.
Right, the heavy hitters.
Steel, cement production, chemical manufacturing, heavy-duty transport trucking, shipping, aviation, where direct electrification is either, technically very difficult or just prohibitively expensive today. Green hydrogen can act as a clean fuel or a clean feedstock in these areas. It offers a viable path to eliminate emissions.
So it can clean up industries that can't easily run on batteries or just plug into the grid?
Exactly. Second, it's a powerful tool for energy storage and grid stability. This is huge.
How so?
Renewable sources like solar and wind are intermittent, right? The sun doesn't always shine, the wind doesn't always blow. Hydrogen provides a way to store massive amounts of excess renewable energy when it's abundant.
When generation exceeds demand.
Precisely. This stored energy can then be converted back into electricity using fuel cells or even turbines when needed, providing reliable, flexible power to the grid, balancing supply and demand.
That addresses a core challenge of relying heavily on intermittent renewables, doesn't it?
It absolutely does. Third, enhanced energy security. By enabling countries to produce a versatile energy carrier from domestic renewable resources and water, green hydrogen can significantly reduce reliance on imported fossil fuels.
Reducing those geopolitical energy dependencies we hear so much about.
Precisely. That bolsters national energy security and resilience. Fourth, it's a driver of significant economic growth and job creation. Building out the green hydrogen economy requires massive investment across manufacturing, infrastructure, technology development.
A whole new ecosystem.
Yes, creating enormous potential for new jobs and economic activity in diverse sectors. A new clean industry being built, essentially.
That makes sense.
Fifth, and perhaps most directly, it's essential for achieving those ambitious climate goals we talked about. The Paris targets, the 2050 carbon neutrality pledges. Without a versatile zero-emission energy carrier like hydrogen for those difficult sectors, hitting those targets becomes significantly harder, if not impossible.
It's an enabler for hitting those net zero goals.
Absolutely. And finally, it fosters technological innovation across the board. Developing and scaling green hydrogen technologies drives advancements in engineering, chemistry, material science, manufacturing, creating spillover benefits for other industries, too.
So putting it all together, you position green hydrogen as a crucial pathway to a sustainable, decarbonized future, capable of integrating with existing systems and tackling some of the toughest emission challenges.
We see it as a vital complementary piece to direct electrification. Both are needed. Hydrogen is essential for a truly comprehensive energy transition.
Now, let's look at how green hydrogen actually moves from production to application. You mentioned the hydrogen value chain earlier. Can you walk us through the key stages you consider when assessing opportunities?
Yeah, the value chain is absolutely central to our investment focus. It begins naturally with production generating the green hydrogen itself, primarily through electrolysis powered by renewables, as we've discussed.
Okay, production is the starting point. Clear enough. What comes next?
Following production, you have storage and transportation. This is a critical bottleneck, frankly. Hydrogen has unique physical properties. It's very light but energy dense by weight, though not by volume.
Tricky stuff to handle.
It requires specialized solutions for storing and moving it efficiently and cost effectively.
What are the main storage methods you look at?
The primary methods today include storing it as a compressed gas under high pressure. That's common for transport, like in fuel cell vehicles and smaller scale storage. Then there's liquid hydrogen. This involves cooling it to extremely low temperatures, cryogenic temperatures for much higher energy density, but it requires advanced energy-intensive cryogenic technology. More complex, more expensive currently. And we also see significant potential in chemical storage methods. Storing hydrogen within solid or liquid compounds like metal hydrides or increasingly ammonia. These can offer safety and density advantages in certain applications.
So different storage approaches depending on the scale and the end use case. And for transportation, how do you move it around?
Transportation involves getting the hydrogen from where it's produced, ideally near cheap renewables, to where it's needed. Pipelines are a key method for large volumes over long distances.
Like natural gas pipelines.
Yes, and there's significant potential to adapt existing natural gas infrastructure for hydrogen transport, maybe blending it initially, or building dedicated hydrogen pipelines. That could be highly efficient.
Adapting existing infrastructure, that's a compelling angle, isn't it? Could save a lot of cost.
It offers significant cost advantages where feasible, absolutely. For shorter distances or areas without pipeline networks, road transport via trucks carrying high-pressure or cryogenic liquid tanks is essential. Ships will also play a role for international trade, likely carrying ammonia or liquid hydrogen.
So, a mix of transport modes.
Yes. Developing innovative, safe, and cost-effective storage and transportation solutions is really critical for integrating hydrogen into the broader energy system and making it widely available.
Okay, so once it's produced, stored, and transported, where does it actually get used? What are the key application areas you see as most promising?
The use and applications span a really wide range of sectors. Transportation is a major area we're excited about.
Cars? Trucks?
Fuel cells powered by hydrogen can provide zero-emission mobility for everything from passenger cars and buses, increasingly heavy-duty trucks, trains, and potentially even ships and aircraft in the future. The only emission is water vapor.
Decarbonizing transport beyond just battery electric vehicles, especially for the heavy stuff.
Exactly. It's vital for those heavier, longer-range applications where battery weight and charging times are problematic. Industrial use is another huge segment.
What kind of industries?
Well, hydrogen is already a fundamental input in processes like oil refining, used to remove sulfur. It's key for ammonia production, which is mostly for fertilizers and chemicals, and metallurgy using hydrogen instead of coal or coke for cleaner metal processing, particularly steel. These are traditionally very emissions-intensive industries.
Cleaning up those industrial giants.
Yes, that's a massive opportunity. Then there's energy storage and power generation, as we discussed, storing large amounts of renewable energy.
Right, the Grid Balancing Act.
Exactly. And fuel cells can convert that stored hydrogen back to electricity, providing grid stability, backup power, or even powering remote communities or data centers. A flexible power source when and where needed. And there's also potential, though perhaps further out, for pure hydrogen in residential and commercial heating. Hydrogen can be blended into existing natural gas networks, maybe 10–20%, to lower emissions from buildings using existing infrastructure.
So the value chain touches on production, handling it safely, and then these diverse end uses in transport, industry, power, maybe even buildings.
That's right. And by investing strategically across this entire chain, from the tech producing it to the infrastructure delivering it and the applications consuming it, we aim to contribute to achieving climate goals, enhancing energy security, and fostering a sustainable low-carbon economy. It's a holistic approach.
We've talked about the necessity, the technology, the value chain. Now let's
Mhm.
talk about the enabling environment. How important is government support and what kind of global momentum are you seeing?
Government support is, frankly, absolutely crucial at this stage. It's a primary catalyst for accelerating the green hydrogen industry. Supportive policies provide the necessary signals, the incentives, the regulatory frameworks to really drive investment and deployment.
What kind of mechanisms are governments using globally? What does that support look like?
The toolkit is quite broad, actually. It includes direct financial incentives, things like grants, loans, tax credits to lower project costs and risks, especially early on.
De-risking the investment.
Exactly. Fee-to tariffs can guarantee stable revenue streams for hydrogen producers. Funding for research and development is vital to push the technological boundaries and bring costs down. Regulatory support, like streamlining permitting or establishing clear standards for hydrogen quality and safety, is also key.
Creating the rules of the road.
Yes. Market incentives, like mandates for hydrogen use in certain sectors or public procurement targets, help create guaranteed demand. And international partnerships facilitate knowledge sharing and coordinated action, which is important for building global supply chains.
Let's look at some examples, starting with the United States. What are the key initiatives driving things there?
In the U.S., a major initiative is the Department of Energy's Hydrogen Energy Earthshot, launched back in 2021.
The Earth shot. What's
Yeah.
the big goal there?
The ambitious target is to dramatically reduce the cost of clean hydrogen by 80%, down to $1 per kilogram within a decade, so by 2030, basically.
$1 per kilogram. That's seen as the magic number.
It's widely seen as the price point needed for clean hydrogen to be competitive with traditional fuels across many applications, yes. The Earthshot also accelerates R&D across the whole value chain.
Cost reduction is paramount for scaling.
Yeah.
What about building the actual infrastructure, the pipes, the stations?
The Infrastructure Investment and Jobs Act of 2021 is providing significant funding for clean energy infrastructure. That includes dedicated funding, billions actually, for regional hydrogen hubs.
Hydrogen hubs.
Yes, the DOE is facilitating the development of these hubs across different regions. The idea is to bring together producers, users, and infrastructure providers in one geographic area to demonstrate integrated hydrogen ecosystems at scale, creating those critical local clusters.
Makes sense.
And there are also federal tax incentives, particularly the 45V production tax credit in the Inflation Reduction Act, designed to encourage private sector investment in clean hydrogen production facilities and fuel cell technologies.
And at the state level.
Beyond the federal push, many states are implementing their own strategies. States like California, New York, Texas, they're actively integrating hydrogen into their transportation, industrial, and power sectors as part of their state-level climate goals. So federal push combined with state-level action in the U.S.
Okay. What about Europe? Europe is often seen as a leader in this green transition space.
Europe is certainly at the forefront of hydrogen development, yes. The EU Hydrogen Strategy, published in July 2020, outlines a very clear vision.
And what are their main ambitions? What are they aiming for?
Their ambition is nothing less than to become a global leader in renewable hydrogen. They've set concrete targets, like installing at least 40 gigawatts of electrolyzer capacity by 2030.
40 gigawatts, that's huge.
It is. To produce up to 10 million tons of renewable hydrogen domestically by 2030 and importing another 10 million tons, they're aiming for a fully integrated European hydrogen market by 2050.
Those are substantial targets. You mentioned hydrogen valleys earlier. Are these part of the EU strategy?
Yes, the EU is actively supporting the development of these hydrogen valleys. They're essentially regional ecosystems designed to demonstrate the feasibility and benefits of integrated hydrogen production, distribution, and use across multiple applications all in one place. They facilitate collaboration and accelerate deployment.
Learning by doing on a regional scale.
Exactly. And beyond the overarching EU strategy, many individual European countries have published detailed national hydrogen strategies. Think Germany, France, the Netherlands, Spain, each with specific targets, funding mechanisms, research priorities tailored to their national economies and strength.
And is the EU backing this with significant funding? Is the money there?
Absolutely. The EU is dedicating considerable investment to hydrogen research, innovation, and infrastructure through major programs like Horizon Europe, the European Green Deal Investment Plan, and the Recovery and Resilience Facility. This financial commitment is essential for overcoming those initial barriers to deployment and scaling up.
So, a really comprehensive, multi-level approach in Europe. What about other key players globally? Who else is making big moves?
Oh, many other nations recognize the strategic importance of hydrogen. Japan, for instance, has been a technology leader for years. They have a long-term vision for a hydrogen society, investing heavily in production, transport, and particularly utilization in vehicles and industry.
Japan's been talking about this for a while.
They have. South Korea also has a very ambitious hydrogen economy roadmap with aggressive targets for fuel cell vehicles aiming for over 6 million by 2040 and the associated infrastructure build-out. They're investing heavily in production facilities and offering incentives.
Ambitious vehicle targets there.
Very. Australia is positioning itself as a future hydrogen export powerhouse. They're leveraging their vast renewable energy resources, particularly solar, to produce green hydrogen specifically for international markets. They're investing heavily in the necessary supply chains and research collaboration.
Exporting sunshine as hydrogen.
Essentially, yes.
Yeah.
And beyond these individual countries, you have important international partnerships like the Hydrogen Energy Ministerial Meeting, which brings together energy ministers from key countries to foster dialogue, share best practices, and collaborate on standards and trade.
It sounds like a true global race, or maybe a global collaboration, to establish these hydrogen economies.
It's a bit of both, I'd say. And these collective initiatives really underscore the critical role governments see green hydrogen playing in achieving climate goals. They're paving the way for a sustainable future through both competition and collaborative efforts, backed by significant investment. This government momentum is a key factor driving the market opportunity we at HydroGenesis are focused on.
That's a great transition. We've covered the big picture, the technology, the global push. Now let's talk about how HydroGenesis fits into this picture. You mentioned it's a pioneering hedge fund in this space. Can you introduce the fund itself?
Yes, HydroGenesis is indeed structured as a hedge fund, specifically dedicated to capturing the investment opportunities presented by the rise of green hydrogen. We are based in Luxembourg, which is a major hub for alternative funds.
Okay.
And we operate under the RAIF structure, that's a reserved alternative investment fund structure. The fund itself is managed by HydroGenesis Investment Fund Management.
And what is the fundamental mission of HydroGenesis? What are you trying to achieve?
Our core mission, really, is to support and accelerate the transition to a sustainable energy future. We do that by investing strategically across the green hydrogen value chain. We aim to provide capital and also expertise to the innovative technologies and the crucial infrastructure projects that will make this transition happen.
You clearly believe green hydrogen is crucial for the future. That underpins everything.
Absolutely. It is a foundational belief for our entire team that green hydrogen is not just a solution, but a crucial solution for combating climate change and enabling countries to achieve their 2050 carbon neutrality targets. Our whole investment approach is centered around this conviction.
And that approach, as you mentioned, covers the entire value chain, not just one part.
Yes, that's absolutely key to our strategy. We invest strategically across the entire hydrogen value chain.
From start to finish.
From the technologies enabling production, like electrolyzers, to the infrastructure for storage and distribution pipelines, tanks, refueling stations, and the companies developing and deploying the end-use applications. This holistic view allows us to capture opportunities across different stages of market development and, importantly, manage risk through diversification. Our commitment is to actively drive the adoption and scaling of this really promising energy solution.
You also highlight that it's an ESG fund.
Yeah.
What does that mean in practice for HydroGenesis? How central is ESG?
Being an ESG fund means that environmental, social, and governance considerations are not just an add-on or a checkbox exercise. They are fundamental to our investment process right from the start, embedded in our due diligence. We invest only in companies and projects that align with our commitment to a sustainable and equitable future. It's integral.
And who is this fund intended for? Who are you looking to partner with as investors?
HydroGenesis is structured for qualified and institutional investors. So investors who are looking to gain exposure to this rapidly growing sector through a specialized, actively managed fund and who understand the long-term nature of this investment.
Is there a minimum investment threshold?
Yes, the minimum investment ticket is set at $1 million.
Okay, so it's aimed squarely at sophisticated investors who understand the complexities and, of course, the opportunities in this emerging market. Let's talk about the people behind the fund. A fund is only as good as its team, right? Who was the management team?
That's very true. We've assembled a team of highly experienced professionals specifically chosen for their combined expertise in sustainable energy, in finance, and in the underlying technologies. This blend of skills is absolutely essential for navigating the complexities of the hydrogen market.
Who leads the team? Can you tell us about the leadership?
Dr. Forzan Rejafar serves as our CEO, founder, and also chairman of the advisory board. He brings over 30 years of extensive experience spanning international trade, financial engineering, fund management, investment strategies, with a particular focus on the energy sector throughout his career. He has a proven track record, having successfully managed significant funds previously.
So deep roots in both finance and energy. Crucial combination. Who else is key to the leadership structure?
David Fleming is our CFO, fund manager, and also a member of the advisory board. He complements Farzan's experience, also bringing over 30 years in trade and investment management. David is responsible for the fund's overall strategy planning, market analysis, trade execution, and acquisition activities.
And are there other specialists supporting them? It takes a village to run a fund like this, I imagine.
Absolutely. A fund like this requires a robust operational structure. We have dedicated portfolio manager focusing on executing the specific investment strategies within the sub-funds. We have a dedicated risk manager overseeing our comprehensive risk framework, a chief technology officer providing deep expertise on the underlying hydrogen technologies we're investing in, and of course, a general counsel and compliance officer ensuring strict adherence to all legal and regulatory requirements. Their roles are vital.
For diligence, oversight.
Diligent financial management, cutting-edge technological oversight, and maintaining regulatory compliance. Yes, it's all crucial.
What do you see as the team's core strength, collectively?
Our strength really lies in the combination of those diverse skills and deep expertise, all working collaboratively. This allows us to not only identify high-potential opportunities across this complex hydrogen value chain, but also to conduct truly rigorous due diligence, to support our portfolio companies effectively post-investment, and to operate with the highest standards of integrity and excellence. We genuinely believe this team is uniquely positioned to navigate the intricacies and capture the potential of the hydrogen market.
It sounds like a team built specifically for this niche, for this moment. Let's delve deeper into the fund structure itself. You mentioned it's a RAIF based in Luxembourg. Can you explain a bit more about the benefits of that particular structure?
Sure. The RAF, the Reserved Alternative Investment Fund, is a well-established and, importantly, flexible investment vehicle in Luxembourg. Luxembourg is a leading global financial center for alternative funds, so it provides a stable and reputable environment.
What are the key advantages of using a RAIF compared to other structures?
A significant benefit is its operational efficiency. While it's fully compliant with the European AIFMD, that's the Alternative Investment Fund Managers Directive, and requires an authorized AIFM, an Alternative Investment Fund Manager, to manage it and oversee compliance. The RAF structure itself is not directly supervised by the Luxembourg regulator, the CSSF.
Interesting. So what does that mean practically?
It allows for greater flexibility and typically a quicker speed to market once the fund is established and managed by an authorized AIFM. You get robust regulation via the AIFM, but more structural flexibility for the fund itself.
Okay, I see.
The structure typically involves a general partner managing the fund and limited partners, our investors, providing the capital. Another key aspect of the RAF structure is its broad investment scope. There are generally no investment restrictions imposed by the structure itself.
So you can invest broadly.
It means we can invest across any asset class or market, entirely guided by our fund's specific outlined investment policy, which is laser-focused on green hydrogen.
And from a tax perspective, what are the implications?
RAFs generally benefit from a tax-transparent structure. This means that the fund itself is typically not subject to corporate income tax in Luxembourg. Taxation occurs at the investor level based on their own tax status and jurisdiction. It avoids double taxation.
That clarifies the structure. You also mentioned earlier that the management team identified 4 distinct areas of opportunity within the hydrogen space and structured the fund with 4 sub-funds. What was the thinking behind creating these separate sub-funds?
Yeah, the rationale there is purely strategic. The green hydrogen market, while it's all interconnected, presents diverse types of investment opportunities. You have public equities, private companies, project debt, even related commodities.
Different risk profiles, different liquidity.
Exactly. Different risk profiles, liquidity characteristics, return potentials. Structuring HydroGenesis with 4 distinct sub-funds allows us to create specific strategies tailored to these different market segments. This supports different investment approaches, it caters to varying investor appetites for risk and liquidity, and it can also help meet specific regulatory requirements or investor preferences more effectively.
It allows for targeted exposure within the overall hydrogen theme. Makes sense. Let's get into those investment strategies in detail then. Maybe start with the overall approach before we dive into the specifics of the four sub-funds.
Sure. Our overarching strategy is built on several core pillars. First, diversification across the entire green hydrogen value chain. We don't want to bet on just one part. Second, an exclusive focus on investments utilizing renewable energy sources for hydrogen production. That's the green commitment. Third, a medium to long-term investment horizon, recognizing that this industry is still developing and scaling.
Patience is needed.
Patience and a long-term view, yes. We employ rigorous technology analysis and, as we discussed, deep ESG analysis for every single potential investment. We also emphasize building strategic partnerships and applying active management across all our strategies. And a core part of our absolute return hedge fund approach is identifying and investing in industries being positively disrupted by the energy transition, and conversely, taking positions against those likely to suffer from this shift.
So capitalizing on both the growth side and the disruption side of the hydrogen transition, what target sectors do you focus on within that value chain?
Our target sectors align directly with the value chain stages we discussed. Hydrogen production technologies like advanced electrolyzers or new production methods. Energy storage and distribution solutions, think pipelines, liquid hydrogen carriers, refueling infrastructure. Fuel cell technology for diverse applications in transport, power, industry. Industrial applications adopting hydrogen, clean steel, green ammonia, sustainable aviation fuels eventually. And research and development initiatives driving future innovation and cost reduction.
How do you approach risk management across these diverse strategies and sectors? It seems complex.
Risk management is absolutely integrated into every step of our process. We have a comprehensive framework designed specifically for identifying, assessing, and mitigating potential risks inherent in this emerging market.
What does that involve?
It includes, first, portfolio diversification across the value chain segments, across different geographies, and across investment types, equity, debt, etc. Second, extremely thorough due diligence covering not just financial aspects, but operational, environmental, social, and governance factors for every single investment. Third, continuous monitoring and reporting of portfolio performance, market dynamics, and emerging risks. And fourth, active engagement with our portfolio companies and other stakeholders.
And that strict adherence to ESG principles we discussed earlier, that's central to risk management as well.
Absolutely. We fundamentally believe that ESG factors are not separate from risk management. They are integral to identifying long-term risks and opportunities. By applying strict ESG criteria in our selection process, we believe we are building a more resilient, more sustainable, and ultimately less risky portfolio for our investors.
Okay, that sets the stage for the overall philosophy. Let's break down the four subfunds and their specific strategies now. Subfund 1 is long-short equity. How does that work in the context of green hydrogen?
Okay, this subfund operates on our core belief that the energy transition, and specifically the rapid rise of green hydrogen, will create significant winners and losers within the publicly traded equity markets. Our aim is to capitalize on this disruption.
So how do you implement that? How do you pick the winners and losers?
We use a rigorous, multifaceted approach. It combines deep fundamental analysis, looking at companies' financials, management quality, competitive position, technology edge. We layer on market analysis, understanding industry trends, government policies, news flow, supply chain dynamics. And we also use technical analysis of stock price movements and patterns to help with timing, entry, and exit points.
And the strategy itself?
The strategy involves taking long positions in those publicly traded companies that we believe are well positioned to benefit significantly from the green hydrogen transition. And conversely, taking short positions in companies that we anticipate will face significant challenges, lose market share, or decline as a result of this fundamental shift.
It's about capturing value from those market shifts, both up and down. What's your general outlook for the green hydrogen equity market? Is it growing?
Our outlook is distinctly positive. We see significant growth potential. Market analysts widely project a compound annual growth rate, or CAGR, of over 30% from 2020 to 2026 for the broader hydrogen market, and we think that momentum continues. This growth is fundamentally driven by falling renewable energy costs, which makes green hydrogen cheaper, increasing global climate concerns driving policy support, and the emergence of new large-scale hydrogen applications across various sectors.
What are the specific risks you have to manage in this long-short equity strategy?
Like any equity strategy, especially in an emerging and rapidly evolving sector, there are risks. Regulatory uncertainty is a big one. Policy changes can significantly impact company valuations. Intense competition is another, as many players vie for market share. Potential technological setbacks or delays can impact specific companies. And of course, there's overall market volatility that affects all equities.
How do you handle those risks?
Our approach manages these through what we consider a moderate risk tolerance for this subfund, combined with disciplined portfolio construction. That means careful position sizing, diversification across different types of hydrogen-related companies, producers, tech providers, infrastructure users, and continuous monitoring of both our holdings and the market landscape.
How do you actually research potential equity investments? Where do you get your information?
We combine that in-depth fundamental analysis to assess intrinsic value and execution potential with broader market research to understand the competitive landscape and regulatory environment, plus technical analysis for timing. We source information from a wide range of places: industry publications, government reports, financial news services, sell-side and buy-side analyst reports. Crucially, we also maintain strong relationships with industry insiders, technology experts, and management teams to gain unique insights that aren't always public.
And what factors are key in your evaluation?
Key evaluation factors include financial performance and projections, the quality and experience of the management team, the company's competitive positioning and technological edge, their strategy for navigating the transition, and their own risk management capabilities. The goal is always to build a diversified portfolio that balances risk and reward effectively.
Can you give some concrete examples, maybe hypothetical, of the types of positions you might take in this fund, longs and shorts?
Certainly. On the long side, we might invest in companies that manufacture key components like electrolyzers or fuel cells, or developers of large-scale renewable energy projects that are specifically dedicated to green hydrogen production. Companies building out hydrogen pipelines or refueling station networks could be attractive longs, or industrial companies successfully pivoting to use green hydrogen in their processes.
Okay, the enablers and adopters.
Exactly. On the short side, we might identify companies heavily reliant on fossil fuels that appear slow to adapt or lack a credible transition strategy. Or perhaps companies whose traditional products or services are being directly displaced by green hydrogen alternatives and seem overvalued by the market.
Betting on the winners and, well, against the perceived losers in the transition. What's the expected return profile for this long-short equity subfund?
For the long-short equity subfund, we typically target an expected annual return in the range of 8–12%. This target is driven by the potential for significant market growth in hydrogen-related companies, combined with our ability to capitalize on the disruption dynamics using both long and short positions. Importantly, we aim for positive returns regardless of the overall market direction by actively managing our net exposure.
That covers the public market strategy clearly. Now, Subfund 2 focuses on private equity. How does investing in private hydrogen companies differ from the public market approach?
Right. Private equity allows us to invest directly in companies and projects that are not accessible via public stock exchanges. This gives us exposure to potentially earlier stage growth and the opportunity for significant value creation that might not yet be fully reflected in public valuations.
What forms do these private investments typically take? Startups, established players.
It can be both. We can provide growth capital to promising early-stage startups that have, say, disruptive technologies or innovative business models in areas like advanced electrolysis, new storage solutions, or software for managing hydrogen systems. We also look at investing in or sometimes acquiring more established private companies or originally equipment manufacturers, OEMs, that are developing key components or integrated systems for the hydrogen value chain. These might already have revenue and customers.
What are the key advantages of this private approach for HydroGenesis and for your investors?
The main advantages are, firstly, the potential for significantly higher returns compared to more liquid public market investments. Of course, this comes with higher risk and lower liquidity, as capital is typically locked up for longer periods. Secondly, private equity allows for much more direct involvement in the strategy and operations of the portfolio companies. This enables us to actively contribute to value creation, working alongside management. We aim for a significantly higher return profile here precisely because of these factors.
And what is that target return for the private equity fund?
For the private equity subfund, given the higher risk and illiquidity, we typically target expected returns of 20% or more per year, measured as an internal rate of return or IRR over the life of the investment. This reflects the potential in the rapidly growing emerging green hydrogen sector, driven by technological advancements and strong demand growth, but also acknowledges the risks involved.
What are the specific risks you need to manage carefully in this private equity space?
Beyond the general market risks we discussed, technological setbacks, regulatory uncertainty, competition, private equity adds several layers. There's execution risk. Can the management team actually deliver on their plan? There's market adoption risk for new technologies. Will customers buy it? There's the challenge of sourcing truly high-quality, proprietary investment opportunities, finding the hidden gems. And as mentioned, the illiquidity risk capital is locked up, typically for 5 to 10 years.
What are the critical success factors, then, for making successful private equity investments in green hydrogen?
Success in this space is heavily reliant on having a deep, nuanced understanding of the specific technologies involved, the market dynamics, the competitive landscape, and the policy environment. Crucially, it also requires strong, trusted relationships with industry insiders, technology developers, entrepreneurs, and strategic stakeholders. These relationships are absolutely vital for sourcing attractive deals others might not see, conducting thorough due diligence, and executing successful investments. Our team's in-depth technical knowledge and extensive network are key strengths we leverage here.
Can you detail the specific investment strategy for this private equity subfund? How do you pick investments?
Our strategy is rigorous, it's data-driven, and it's focused on identifying high-quality investments both in private companies and sometimes in specific large-scale projects. We look for companies with strong, demonstrable growth potential. We need experienced and capable management teams we can partner with. A clear competitive advantage is essential, often based on proprietary technology, unique market positioning, or first-mover advantage. And critically, alignment with our social and environmental impact goals is non-negotiable. We take a long-term perspective and aim to work closely with the management teams of our portfolio companies to help them scale and succeed.
What specific types of private opportunities do you focus on within that framework?
We focus on promising early-stage companies that are developing those potentially disruptive technologies or innovative business models crucial for the future hydrogen ecosystem. We also invest in or acquire established private companies or OEMs that already have a solid track record, proving technology, a competitive position, and the resources needed to scale their operations significantly. Project investments are also a key focus.
Project investments, like building factories.
Exactly. Funding the construction of large green hydrogen production facilities, networks of hydrogen fueling stations, or essential distribution infrastructure like pipelines or terminals. These require significant capital and offer a different risk-return profile, often with long-term contracts underpinning them.
And you mentioned a specific focus on developing countries for some of these project investments. Why there?
Yes, we see significant opportunities for accelerated adoption of green hydrogen technology and infrastructure in certain developing economies. These regions often have abundant, low-cost renewable resources, like sunshine or wind, and a pressing need for clean energy solutions to fuel their growth and reduce pollution. Investing in well-structured projects there can generate attractive financial returns while also making a substantial positive social and environmental impact. It's a potential win-win.
How do you conduct the research and analysis for these private investments? It must be different from analyzing public companies.
It is more intensive, definitely. Our research process is multi-layered. It includes extensive industry research, understanding market trends, regulatory frameworks, technology roadmaps, competitive positioning, using market reports, expert networks. We conduct detailed company analysis, which involves rigorous due diligence of their financials, their management team's capabilities, their intellectual property portfolio, their technology readiness, existing partnerships, customer traction.
And for the projects.
For project investments, we perform in-depth technical analysis, reviewing the engineering design, technology choices, construction plans, environmental impact assessments, regulatory compliance, and detailed cost estimations. Financial modeling is absolutely crucial for both companies and projects involving scenario analysis, discounted cash flow valuations, sensitivity analysis, and detailed financial projections under various assumptions. And throughout, we continuously leverage our network and partnerships to identify proprietary opportunities and gain critical insights that aren't publicly available.
What are the key criteria you always come back to in your analysis when making the final decision?
We always come back to a core set of criteria. Is there potential for significant growth? Does the company or project have a clear and defensible competitive advantage? Is the management team experienced, capable, and trustworthy? And, crucially, does the investment align with our social and environmental impact goals and contribute positively to a sustainable future? All boxes need to be ticked.
Finally, for private equity, the exit strategy is vital. You need a way to return capital to investors eventually. What potential exit paths do you plan for?
Absolutely. Having a well-planned exit strategy from the outset is essential for any private equity investment. The specific path depends heavily on market conditions at the time, the performance of the investment itself, and the nature of the company or project.
What are the common routes?
Potential exit routes include a trade sale, selling the company to a larger strategic buyer in the energy or industrial space, or perhaps to another private equity firm that's consolidating in the sector. Selling to a special purpose acquisition company, or SPAC, has been a relevant option, offering a relatively quick route to public markets, though that market fluctuates. An initial public offering, or ITO, is a possibility for companies that achieve significant scale, growth, and strong financials. We might also pursue a secondary sale, selling our stake to other private equity funds, or large institutional investors like sovereign wealth funds or pension funds looking for mature assets in the sector. Recapitalization is another option, where the company takes on new debt to return capital to us while we potentially retain some equity, or even a management buyout in certain situations. The key is flexibility in planning.
That provides a clear picture of how you aim to generate returns and eventually provide liquidity in the private space. Moving on, Subfund 3 focuses on debt financing. What role does providing debt play in the green hydrogen ecosystem? Why not just equity?
Providing debt financing plays a crucial complementary role in the green hydrogen market. It offers an alternative source of capital for projects and companies, particularly where traditional bank financing might not be readily available yet, or perhaps not perfectly suited to the risk profile or stage of development. It helps support the development and scaling of essential infrastructure and technology deployment.
And for investors?
For investors, debt typically offers the potential for attractive risk-adjusted returns, often with more predictable cash flows compared to equity investments, as you have scheduled interest payments and principal repayment. It's a different part of the capital structure with a different risk-reward profile.
How is HydroGenesis positioned to operate effectively in this debt space?
Our position here is strengthened by our team's extensive experience in both traditional debt finance and specifically renewable energy project finance. This, combined with our deep, specialized understanding of the entire hydrogen value chain, the technologies, the risks, the players, allows us to structure tailored financing solutions. Solutions that are aligned with the specific needs of green hydrogen projects and companies, while also adhering strictly to our ESG goals.
Can you outline the different debt strategies you employ within this subfund and the kind of returns you expect from each?
Sure. We employ a few key strategies. Firstly, project finance. This involves providing debt specifically for the construction or operation of defined green hydrogen projects. Think large electrolysis plants, dedicated pipelines, or networks of fueling stations. These projects typically benefit from long-term revenue contracts, like power purchase agreements or hydrogen offtake agreements, leading to relatively predictable cash flows. Expected returns here are generally in the 5–10% range.
Okay, stable, project-backed debt.
Exactly. Secondly, corporate finance. This involves providing debt directly to companies operating within the hydrogen value chain, could be fuel cell manufacturers needing working capital, or renewable energy developers building hydrogen capabilities alongside their solar or wind farms. These companies usually have more diversified revenue streams, potentially offering slightly higher returns, say 6–12%, but also reflecting a different corporate-level risk profile.
So project debt generally represents lower risk for a slightly lower return compared to corporate debt.
Generally speaking, yes, that's often the case. We also utilize mezzanine finance. This is a hybrid form of capital sitting between senior debt and equity. It's often unsecured or subordinated debt, sometimes with equity kickers attached. It's used for projects or companies needing more flexible capital beyond what traditional senior lenders will provide. This carries higher risk than senior debt, naturally, but targets commensurately higher returns, typically in the 8–15% range.
Filling a gap in the capital stack.
Precisely. Another strategy is refinancing existing debt. This involves providing new debt, perhaps at lower interest rates or with longer repayment periods, tenors, to replace a project's or company's existing debt structure. This can offer attractive risk-adjusted returns for us, perhaps 4–8%, while significantly reducing the cost of capital for the borrower, making their project more viable.
And a final strategy sounds like it bridges the gap between debt and equity even more directly.
Yes, that's convertible debt to equity. This involves providing debt financing that includes an option for us, the lender, to convert the outstanding debt into equity in the company at a later date, often at a pre-agreed valuation or a discount to a future funding round.
Why use that structure?
This structure offers investors, like us, potential upside participation similar to equity if the company does very well, while providing the downside protection of debt initially. For the borrower, it can be a less dilutive way to raise capital early on compared to straight equity. It's often suitable for early-stage or innovative companies where valuation is uncertain. Expected returns for this hybrid approach reflect that equity upside potential, targeting the 10–20% range.
That provides a whole range of debt-based opportunities within the hydrogen sector, catering to different risk appetites.
That's exactly right. By constructing a well-diversified portfolio of hydrogen-related debt across these different strategies, risk profiles, and parts of the value chain, we believe we can offer attractive and relatively stable risk-adjusted returns to our investors while directly supporting the crucial growth and deployment of green hydrogen technologies and infrastructure.
Okay, that makes sense. Finally, Subfund 4 is commodities trading. This seems quite distinct from the other funds focused directly on companies and projects. What's the focus here?
It is a distinct strategy, yes, but one we see as increasingly relevant and potentially lucrative in the developing hydrogen market. This subfund focuses on actively trading physical hydrogen itself, where markets develop, long-term offtake agreements for hydrogen supply, carbon credits generated from emission reductions linked to hydrogen use, and other commodities whose markets are likely to be significantly influenced by the hydrogen transition.
Which other commodities?
Things like natural gas, as hydrogen potentially displaces it, electricity prices, as hydrogen production becomes a major power consumer and also a storage provider, and certain metals critical for hydrogen technologies, like platinum and iridium used in electrolyzers and fuel cells. It's an innovative strategy in a rapidly growing, interconnected market space.
What market dynamic is driving the need for this specific trading focus? Why now?
Well, as the production and use of green hydrogen scale up globally, it inevitably creates a growing market for trading the physical commodity, managing price risk through derivatives, and trading related products like carbon credits. This market is still emerging, particularly for hydrogen itself, but it's expected to grow significantly in the coming years, creating opportunities for skilled trading operations with deep market knowledge.
What's your approach to commodities trading in this specific context? It requires a different skill set.
It does. We leverage our team's deep expertise drawn from backgrounds in traditional energy and commodities trading, combined with our specialized fundamental knowledge of the green hydrogen market itself, the supply, the demand, the infrastructure bottlenecks, the policy drivers. We employ a range of sophisticated trading strategies utilizing futures contracts, options, swaps, and other derivatives to manage risk effectively and generate returns from perceived price movements, arbitrage opportunities, and market inefficiencies.
And the overall goal of this particular subfund?
The goal is to develop a diversified portfolio of hydrogen-related commodity positions with the potential for attractive absolute returns. A key aspect here, particularly for institutional investors, is that these returns can often have a low correlation to traditional equity or fixed income assets. This can provide valuable diversification benefits for an overall investment portfolio.
Can you elaborate on some of the diverse trading strategies you might employ? It sounds quite active.
Certainly. It's a dynamic approach. Strategies include taking straightforward long or short futures positions in hydrogen when listed, electricity, natural gas, or key metals to profit from anticipated price direction based on our fundamental analysis. We use spread trading to capture opportunities from price differentials between related commodities, different delivery locations, or different points in time on the futures curve. Options trading provides flexibility and leverage, allowing us to structure trades to profit from expected price moves, hedge existing positions, or capitalize on changes in market volatility.
It goes beyond just buy and hold.
Definitely. Fundamental analysis is crucial, constantly assessing supply and demand balances, inventory levels, geopolitical factors impacting energy markets, policy changes. We also incorporate technical analysis, looking at price charts, patterns, and indicators to help inform timing and risk management. Arbitrage strategies seek to exploit temporary price discrepancies across different markets or related contracts. These are often short-lived opportunities requiring speed and efficiency. Seasonal trading looks for recurring price patterns linked to predictable demand cycles, for example, in heating or cooling demand impacting electricity or gas prices.
What about very short-term trading?
Shorter-term strategies like scalping might be used, aiming to profit from very small, frequent price movements, requiring sophisticated algorithms and low-latency execution. Event-driven trading seeks to capitalize on opportunities arising from specific news releases, policy announcements, or unexpected disruptions. Volatility trading uses options to profit specifically from expected changes in market price volatility itself, regardless of direction. Statistical arbitrage uses quantitative models to identify potential short-term mispricings based on historical relationships. Momentum trading involves following established price trends, and position trading involves taking longer-term views based on our fundamental analysis, which can include participating directly in the market for long-term physical hydrogen offtake agreements.
That's a very comprehensive and active set of strategies for this subfund. What's the expected return profile here? It sounds like it could be quite variable.
The expected return in commodities trading is inherently more variable, yes. It's subject to market conditions, the success of strategy execution, and the level of risk taken. It is generally designed to target higher potential returns than traditional fixed income, but it comes with potentially higher risk and volatility compared to, say, the long-short equity or the debt strategies.
Especially in an emerging commodity like hydrogen.
Exactly. Hydrogen itself is an emerging commodity market, which adds to the risk profile as liquidity and price discovery are still developing. Carbon credits, on the other hand, represent a more established, albeit still volatile, market. For a well-managed, diversified commodities fund operating in this dynamic space, we would typically expect potential returns in the range of 10–20% per year, while always emphasizing that past performance is not indicative of future results and performance can vary significantly year to year.
So potentially high returns, but definitely with the volatility and risk typical of active commodities trading.
That's the nature of this particular market segment, yes. It offers a different kind of exposure within the hydrogen theme.
We've touched on this several times, but it seems really central to hydrogenesis. It's clear that ESG isn't just a marketing term for you. You integrate it deeply into the investment process. Can you reiterate exactly how that works across all these different subfunds?
Yes, I'm glad you brought it up again because it's fundamental to who we are and how we invest. We strongly believe that integrating environmental, social, and governance ESG considerations is absolutely crucial, not just for ethical reasons, but for the long-term sustainability of our investments and for generating durable financial value. They are intertwined.
How specifically do you build it into the due diligence process? Is it a separate check or integrated throughout?
It's integrated from the very beginning into our due diligence process for every single potential investment opportunity. It doesn't matter if we're evaluating a new technology patent, assessing a private company for the PE fund, underwriting a project for the debt fund, or even considering counterparties for the commodities fund. ESG is part of the initial screening and the deep dive.
What areas do you assess?
We conduct thorough research to evaluate the potential environmental impact of the investment, looking beyond just carbon emissions to things like water usage, land use impacts, biodiversity effects, waste management. We assess the social impact on communities and stakeholders. This includes looking at labor practices, health and safety records, community engagement processes, supply chain responsibility, and we evaluate the quality of corporate governance, examining the management structure, board independence, transparency in reporting, executive compensation alignment, and overall ethical practices.
On compliance with laws and regulations is part of that ESG check too.
Absolutely. A baseline requirement is ensuring that all potential investments are compliant with applicable laws and regulations related to environmental protection, labor standards, anti-corruption measures, and corporate ethics. But we aim to go beyond just baseline compliance.
You also mentioned relying on external verification or ratings. Who do you work with and why?
Yes, we believe in leveraging external expertise and independent data to strengthen our own internal assessment. We utilize ESG metrics and ratings from recognized, credible industry leaders like Sustainalytics and MSCI ESG Research.
How do they help?
Sustainalytics provides ESG risk ratings, which assess a company's exposure to material ESG risks relevant to its specific industry and how well it's managing those risks relative to its peers. This helps us identify potential blind spots or areas of concern, but also opportunities where companies are leading. MSCI ESG Research offers a comprehensive rating system based on thousands of data points across numerous ESG issues. It evaluates a company's resilience and ability to manage ESG risks and opportunities relative to competitors. This provides valuable benchmarking and comparative analysis across sectors and geographies.
So using these external objective sources enhances your own internal analysis and decision-making.
Exactly. By leveraging both our internal expertise and these external ESG ratings and data, we believe we significantly enhance our due diligence process. It helps us make more informed investment decisions that consider the full spectrum of risks and opportunities: financial, operational, technological, and ESG. Ultimately, our goal is to generate attractive financial returns and simultaneously contribute meaningfully to a more sustainable and equitable world. It's core to our investment philosophy and our value proposition to investors.
That brings it all together nicely. To summarize the fund structure and the distinct investment options for potential investors, can you give us a quick snapshot of the key terms for each of the four sub-funds again? Side by side almost.
Certainly. Let's recap the key terms for each. First, the long-short equity sub-fund targets 8–12% annual returns, has a relatively short one-year lockup period, distributions are typically made yearly, and it offers open-end redemption, meaning investors can typically redeem quarterly or annually after the lockup. Second, our private equity sub-fund targets significantly higher returns, 20% plus per year IRR, reflecting the illiquidity. It has a much longer lockup period of 5 years, plus a potential 3-year extension for orderly exits. Distributions are typically made only at exit of an underlying investment, and it's a close-end redemption structure, meaning redemption isn't available on demand. Capital is returned as investments are realized.
Got it. Longer term, higher potential return, less liquid.
Precisely. Third, the debt financing subfund targets returns generally between 5% and 15%, depending on the specific debt strategy mix. It also typically has a 5-year plus 3-year lockup structure, similar to the PE fund, reflecting the often project-based nature of the loans. Distributions from interest income are usually yearly, and it's also a close-end redemption structure.
Okay, stable income potential, long-term horizon.
Yes. Finally, the commodities trading subfund targets 10–20% annual returns, acknowledging the higher volatility. It has a shorter one-year lockup, similar to the equity fund. Distributions are typically planned quarterly, reflecting the potentially more frequent realization of trading profits, and it also offers open-end redemption.
So different risk-return profiles, different liquidity options, all housed within the overall HydroGenesis fund focused on the green hydrogen investment theme.
Precisely. It's designed to offer choices based on specific investor objectives, risk tolerance, and liquidity needs, while maintaining that core, unwavering focus on the green hydrogen transition.
What are some of the other key operational terms investors should be aware of? Currency, minimums, fees?
Sure. The base currency for the fund and all sub-funds is US dollars, USD. As mentioned earlier, the minimum ticket size for investment across all sub-funds is $1 million. The investment management is handled by HydroGenesis Fund Management SA. In terms of fees, the management fee is typically 1.5% per annum on invested capital, or NAV, and the performance fee is 15% of profits above a certain hurdle, with no watermark currently specified, meaning the performance fee resets each period.
And the operational ecosystem around the fund, the service providers.
Yes, the essential third-party service providers are in place or will be formally appointed as needed. This includes the distributor, which is HydroGenesis Fund Management SA itself, a reputable custodian bank to hold assets securely, an independent fund administrator to handle NAV calculation and reporting, an auditor for annual financial checks, legal counsel for regulatory and contractual matters. The overseeing regulator in Luxembourg is the CSSF, acting indirectly via the required appointment of an authorized AIFM. We will appoint a depository bank as required by AIFMD regulations and a prime broker or brokers to facilitate the trading activities, particularly for the equity and commodities funds.
That provides a clear picture of the operational framework supporting the fund.
Yes, it covers the necessary structure and key parties required for the fund's compliant and efficient operation.
This has been a truly deep dive, thank you. We've journeyed all the way from the urgent global challenge of climate change.
A massive challenge.
Explored the transformative potential of green hydrogen as a critical piece of the solution. Examine the significant governmental and policy push driving this market forward globally. And now, we've walked through in detail how the HydroGenesis Investment Fund is specifically positioned. With its experienced team, its strong ESG focus, and its diverse strategies across the entire value chain, aiming to capitalize on this evolving landscape.
It really feels like a convergence point, a convergence of a global imperative, the need to decarbonize, and a significant tangible investment opportunity that is rapidly taking shape right now.
And for qualified and institutional investors listening, it presents a distinct opportunity, as you've laid out, to participate in this potentially high-growth market while actively contributing to a sustainable future. That alignment seems key to your approach.
It is. We genuinely see it as a way to put capital to work addressing one of the most critical challenges of our time, but doing so within a structured, professionally managed framework designed to generate competitive financial returns alongside positive impact.
As we wrap up, let's just pause and reflect for a moment on the sheer scale of the energy transition that's required globally. Meeting those ambitious 2050 climate goals, hitting net zero. It isn't just about incremental changes, is it? It's about fundamentally rewiring our entire global energy system.
It's a transformation on an unprecedented scale.
And we see today how innovative technologies like green hydrogen are absolutely essential pieces of that massive puzzle, particularly as you highlighted for decarbonizing those really tough, heavy industries and long-distance transport sectors where other solutions face limitations.
Green hydrogen is arguably one of the few truly viable pathways we currently see for achieving deep, near-complete decarbonization in many of those critical areas.
Henna Gygax, she's the Chief Investment Strategist at HydroGenesis Fund Management. Henna, a huge thank you again for joining us and sharing your insights.